Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing pet stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a micro cap company, 64 million market cap. They're trading at $3.09 a share, and they have 21 million shares outstanding. PetMed Express is a pet pharmacy in the United States. The company markets prescription and non-prescription pet medications, health products, and other supplies for dogs, cats, and horses. The company offers things like flea and tick control products, bone and joint care products, vitamins, treats, nutritional supplements, hygiene products, and household pet supplies, in addition to its main product line of prescription medications, including heartworm preventatives, flea and tick preventatives, arthritis, dermatitis, thyroid, diabetes, pain medications, heart and blood pressure, and other specialty medications. They were founded in 1996, headquartered in Florida. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looked pretty good in 22 and 23, 17 million and 23 million, but they had their highest revenue ever in 2024, and they had negative free cash flow. It looks like expenses were going up. That's why they got squeezed out of the market, but they had a small positive in the trailing 12 months, only 1 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. Similar trend, positive, positive, negative, positive. It's almost zero in the trailing 12 months. Revenue is a sales for the company, and that peaks in 2024, 281 million, but then it drops to 247 million, which is lower than 22 and 23. They generate a lot of revenue per share, $12 per share. They must have an amazing price to sales ratio. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 148 million. We discounted those numbers back to today's and weighted average cost of capital. We get a value of the company of $112 million. We divide that by 21 million shares. And we get a calculated stock price of $5.39. They're trading at $3.09, so they're trading at a 43% discount. It's a really strong buy according to the model. If they can get back to 2022, 2023 levels, the stock could 10x. Although I'm assuming they're going to have pretty low free cash flow in the near future. Even if they get this low number, they seem really undervalued. So if they don't go bankrupt, it could be a really good investment. There are 5 companies in the same industry as pets, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $4 million in CapEx, which is the median. Walgreens spends the most, $1 billion. They're debt-free, which looks good. They used to pay a high dividend. They don't pay a dividend anymore. Walgreens pays almost 7%. They generate $17 million of free cash flow, which is the median. They rank 3rd in market cap, right in the middle. Price to book is also equal to the median. We can't look at their PE. They have negative earnings, similar to High Tide and Walgreens. They have the best price to free cash flow, which I think is the most important metric to look at. A good price to sales, 0.6. They generate 247 million of revenue, which is in the middle of the 5 companies. They're trading 53% below their 52-week high. They're at 309. The 52-week high is 660. And they're trading 5% above their 52-week low. The stock is pretty much at its all-time low. It just keeps going lower and lower. So either the company will go out of business or the stock will go up a lot. There's not that much in between with this one. If you put $10,000 into this company 10 years ago, after 2 years, you would have been over $30,000. But if you're still holding on, that $10,000 would be $2,600, a 74% loss. So to summarize, I have them trading at a 43% discount, ranking 5 out of 10. Would I buy it short term? 6 out of 10. It's at its all-time low. Long term, I'm not too sure. 4 out of 10. Seems a bit risky. Ratios look good. Great price to free cash flow. Although we can't look at the PE, so I give it 7 out of 10. Financials aren't so good because their free cash flow is down a lot. At least it's positive in the trailing 12 months. It was negative in 2024. And revenue seems to be on a downward trend. Let's take a look at their income statement. Here's the 4th quarter of 2024 compared to the 4th quarter of 2023. Revenue looks bad. 65 million all the way down to 53 million. $12 million increase. That's a pretty big drop percentage-wise. Let's get more of a breakdown of their revenue. Here's the only breakdown they provide. Reorder sales, I guess that's subscriptions, 45 million. That's down from 54 million. New orders, that's down from 9 million to 6 million. And membership fees, 2.4 to 1.8 million. Everything is down. Here are the percentages. New order sales is down the most, 31%. So they're not getting as many new customers. That's very worrisome. Total revenue is down 19%. Let's go back to the income statement. Below revenues, cost of revenue, 38 million. So that gives them a gross profit of 15 million. Last year was 18 million. Then you have operating expenses, G&A, 11 million. That's down from 13 million. At least their expenses are down. Advertising is down a lot, almost cut in half, from 5.8 million to 3 million. Then you have depreciation and amortization, 1.6 million. Operating expenses, 15 million. So even though revenue is down a lot, their operating loss is better. Last year, they had an operating loss of 3.1 million. Now it's under $500,000. So that means they lowered their expenses more than their revenue dropped. They received 28 million of interest on their investments. They had a gain in other income of 180,000. They had a gain of 28,000. That's the interest they received on their investments. A gain of 180,000 other. So their pre-tax loss, 240,000, a lot better than last year. They paid 465,000 in taxes. Last year they had a tax benefit of 600,000. That's why their net loss is better than their pre-tax loss. Net loss of 2 million, pre-tax loss 2.6 million. But for this quarter, the net loss is 700,000. Loss per share 3 cents. And they did add shares. Last year 20.4 million, now 20.6 million. Let's look at the balance sheet. Their total assets 145 million. Last year 170 million. 68 million of current assets. These are assets that can be liquidated into cash within 12 months. 50 million of cash. Inventory 12 million. They have a lot of PP&E, 28 million. And goodwill is from acquisitions, that's 27 million. Intangibles is also from acquisitions, 15 million. Because it's really hard to internally generate intangible assets. If you do see intangible assets on the balance sheet, it's almost always from acquisitions. Liabilities, 49 million. Which is down a lot. They have no debt, as you can see here. Their biggest liability is sales tax payable. This is how much money they owe on their taxes within the next 12 months, because it's in the current section. So these are taxes they collected when they sold products. Then they have to give this money to the Florida Taxing Authority. Equity is assets minus liabilities, 96 million. The way you calculate that, you take your assets, 145 million, minus your liabilities, 49 million, and you get your equity, the value of the company according to the balance sheet. Additional paid in capital is how much money they receive from selling stock, selling their business. Retained earnings is how much they profited from running their business. It's a sum of all their prior net incomes minus the sum of the dividends they paid out. Let's look at the statement of cash flows. This is for the trailing 9 months. So in the operating cash flow section, they had a cash loss of 2.3 million. Last year, 2.8 million. So that's not good. They're losing cash by running their day-to-day operations. In the investing section, they bought 2.7 million of PP&E. Last year, they spent 36 million of cash by acquiring PetCare RX. Here's an article about that acquisition. PetMed Express completed its previously announced acquisition of PetCare RX, a leading supplier of pet medications, food, and supplies. And they paid $36 million for that acquisition, all cash. Let's go back to the statement of cash flows. So in the trailing 9 months, they paid $176,000 of dividends, but they cut their dividend to zero. So they're not paying any dividend this year, as far as I know. Last year, they paid a lot of dividends, 12.4 million. They may bring their dividend back if they start becoming profitable again. Let's take a look at the company on Simply Wall Street. Its last price, 309, 64 million market cap. It is up in the past week, up 1.5%, but down 25% in the past year. Here's where the stock has been trading since the late 90s. It looks like it was $1.58 stock split adjusted. Its lowest point ever was in 2001, 15 cents. Imagine getting it at 15 cents, then riding it all the way up to $50. You could have retired. I feel sorry if you bought it in 2018. It went from 50 all the way down to 15. There was a little run up post-COVID. It looked like a pretty good stock at that point. It was trading in the high 30s. But then it really struggled since then. it pretty much went down. There was ups for some time frames, but it went down overall. In January 2023, it was still over $20. I actually bought some. I lost a good amount of money, probably half my investment. By the beginning of 2024, it was a little over $7. It fell to $3 in August. It looked like there was some hope because it did come up from $3 to $6.60. So in December 2024, it was between $6 and $7. But as you can see, it went down a lot since then. It really fell off a cliff the past month. It was $4 at the end of March. Now it's down to $3. It could be a really good swing trade, but if you have a weak stomach, I wouldn't buy a stock like this because it could stress you out. Simply Wall Street's valuation is 6 cents. They say the stock is 4,900% overvalued. Two analysts priced this stock at $3.60. They say it's undervalued. Their 2024 revenue was $247 million. Their fiscal year ends March 30th. So two analysts project $231 million of revenue for fiscal year 2025. Fiscal year 2026, $226 million of revenue. And one analyst forecast their 2027 revenue $220 million. So all the forecasts are going down. Here's their revenue since 2014. Its highest ever was 2020, $312 million. And then it came down to $256 million, up to $281 million fiscal year 2024, but it's down in the trailing 12 months at $247 million. This red line is their debt. They're debt-free. Looks like they never have debt. And their equity was highest in 2021, $140 million. It's down to $96 million. I did some extra due diligence on this stock a couple of years ago, and that's why I bought it, because they were paying a high dividend, they were debt-free, and they were cash flow positive. Still lost on that investment. This green line is their cash of $50 million currently. Since they're debt-free, there's no chance of bankruptcy, because the way you go bankrupt is defaulting on your debt payments. You can see they always paid a nice dividend, 4% in 2015. It did get down to 1.9% in 2017, then up to over 5% in 2019. And it was almost 8% when I bought the stock, or a little before I bought it. Then they slashed their dividend, and the forecast is 0% by 2027. The CEO's salary is $128,000. It looks like she's been CEO for only 1 year. Sandra Campos, she's a smoke show. Let's see what they say about her. Here's an article from April 2024. Well, they announced her being the CEO. She's a retail e-commerce veteran. She was on the company's board of directors, and she remains on the board. She brings a deep understanding of the industry and company. Matt Hewlett stepped down as CEO and president of the company. I wonder why it didn't work out with Matt. She was the CEO of Diane von Furstenberg. She had leadership roles at Polo, Ralph Lauren, and Nautica. She's the top 100 Latina leaders. In the past year, lots of insider buying. Only one sell, a small sell. Look at all these buys at $4, $5, $5.50. So you could get a better deal than these entities if you buy it now. 42% of the companies owned by the general public, 37% by institutions, 9% by private companies, 6% by hedge funds, and 5% by insiders. Nina Capital Holdings is the biggest shareholder. Nina Capital looks like a VC firm. Renaissance Technology owns 6%. The usual suspects, Vanguard, BlackRock, Hermes, 2.6%, Geode, 1%, UBS, 0.7%, and Schwab, 0.5%. Their employee count has gone up from 182 to 287. It was a little over 300 in 2023 though. And the ticker trades on the NASDAQ and Deutsche Börse. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.